Hello, everyone. My name is Hunter Smith, and I am very excited to be with you on this sunshiny day here in Salt Lake City, Utah. We are going to be doing our market recap today. First things first, though, I want to jump into the legal stuff and get that out of the way. This demonstration is designed to instruct you on using Metastock and accompanying software plugins, and it's not a recommendation to buy or sell, but rather guidelines to interpreting and using these specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of our software, any trading strategies or information provided with the company. Now that we have the boring part out of the way, I would like to bring in Miss Anne-Marie. Thank you so much for joining us today. Can you hear me okay?
I sure can. I sure can.
Wonderful. I'm going to go ahead and make you the presenter here.
Great.
Should allow you to, oops, give me just a second. I'll change it.
You just made me the presenter.
Let's see here. Click the wrong button. So let me change it here. Perfect. Maybe not perfect.
You can do it, Hunter. We're all behind you. You're doing great.
I'm trying. It tells me one thing, and it's click on Anne-Marie, and it says, "Do I want to make Greg Lewis a presenter?" And I don't.
I do not want to be a presenter.
I don't want to make you a presenter.
And I don't think anybody wants me to be a presenter.
I figured it out. I think. Did it?
Yes, you did. You did. Look at that.
It's Friday. Please forgive me.
Absolutely. It's been a big week, too. Let me shut this, and let me shut this, and let me shut this, and let me shut this. All right, so thank you everyone for joining, and if you're going to be looking at the slide versus in a recap, there'll be lots of great info for you to use coming forward. We had a very interesting week, and so of course the plugin I have to have a look at things. I am broadcasting to you. I was going to do it outside, but the wind is blowing at about 15 miles an hour, and it's almost blew me away, and so I am in the Grand Hot Pot here in Park Ridge. It's right across the street from the library. I wanted to get out and get some sunshine, and so I hopped in here. And now, if you're ever in Park Ridge, this is a great place to have hot pot. Okay, so there you go with that. If you're wondering, why does it look like she's sitting in a restaurant? Okay. So that being said, we had a very interesting week. And so what we're going to look at is the target-rich plugins and get you a feeling of the broad markets. Now, I think we can see that this great big zone here that has the red is the coronavirus information, and then this is the subsequent rotation. So just a little bit of a backdrop. The markets are in a place where the Fed repurchasing window stays open and they can borrow money over short periods of time. And what they've been doing is trying to increase their alpha. And so the traders and big money houses are reinvesting into the market to capture as much alpha as they possibly can. And alpha, of course, is that extra bit that you can catch using leverage that's outside of the regular motion of the market. And so what's happened is it's been sort of this race for yield. And then about 6 days ago, we had this red diamond appear. And when the red diamond appears in this system, it says, hey, listen, you've got to take some profit. So this was the area for the buy. You could have bought when the candlestick showed up or the next time it comes into the region that the candlestick was showing up. So that up here tells us, hey, we need to chill out. And for me, that's when I went flat because I don't believe that the market is pricing in the risk of anything, particularly the global slowdown that's going to occur with literally 1/10 of the human population in quarantine. And now there's just starting to come off of quarantine in China, and news is starting to come out about all kinds of different things. And so we started moving sideways. And then today was the second break after yesterday that said, hey, listen, this is a warning sign. And so the things we're going to look at today are, wait a second, if this is a rollover, how can I position myself properly? And if it's going to be a first pass bounce, like it did here, big sharp move down, it holds and then comes back, where might that be? And so really, as we go through the different areas, and I've got some charts up that show different areas. This is the E-mini S&P 500. So we're looking at really the SPX here, the futures contract event. You can see all this major congestion sitting right down here at the 3290 zone. What I like to do when I look at a chart is try to be as simplistic as possible. The first thing I say is, where is resistance and where is support? Well, old resistance becomes new support here. And when it broke yesterday and recovered, but did not recover over that diamond, it's a huge warning zone. And so that area told me, hey, listen, what we need to be looking at is a deeper reversion to the mean. So my suspicion is twofold. One, you can see this old resistance here, new support. Slope of our moving averages are upward. And so when we have upward moving averages, it means that on average, everybody's still buying. Downward moving averages mean on average, everybody's selling. So if on average, everybody's buying, it means that we're going to wait until it comes into support, and then folks like me that are value buyers are going to start taking a look at the market from the bullish side. Otherwise, we're just going to either stand to the side or take a short-term fade on the market. These sorts of days really make people very nervous, as well they should be. But what we should be thinking about whenever we are moving up in a formation, and you've got, listen, any kind of moving average will work as long as it's not one that's so tight that it wiggles all over the place, and the only way you see it is with aggressive upward entry. So this one is a 7 triangular, and what the 7 triangular does is smoothen out motion, because that's really all I care about. An average is an on average, what are people doing? This one is a 14 exponential. This is very familiar. Everybody knows these. And so these are actually things that people will look at. And so I am suspecting that, see how this area is sideways? And we bounced, we came into the zone and we popped up. And we are holding above that area. So what people are still trying to do is buy at support. You can see that. That's why a wick appears. A wick appears because people are buying at support. So we have to think about, if big money is buying at support, what does that mean? It means that on Monday, we need to be either above this zone, or if we're below it, we're heading lower. And that really is what I want you to think about. From a daily chart, if you lose the close of that chart, you are going to try and hit the low of the chart and then the low of the next congestion area. If indeed that happens and you come into this area, the next new group of buyers are going to come in, and they're either going to be successful and will have a bounce, or they'll be unsuccessful and they'll lose that support. So for us, risk is very easily defined. It's defined as, if I come here and it bounces, I should have all of this be buying pressure, so my stop can be fairly tight. And this is how traders who really are managing risk, those of us who trade to eat, right? This is what we're looking at. And so here's the number one thing to look at. The broad market, the SPX, that holds all kinds of things in it, typically a lot of bigger companies too, right? Things that have large market caps. Those have been holding up very well. We had our first sell. Okay, the next one to look at really is, where is it? Let's open up the YMH0 and then do the CLJ0. And then we'll talk about gold because a lot of people have been hearing about, hey, what do I do about gold? And then the NQH0, which everybody's looking at, that's tech, right? And so if we, did I zero it out? Sorry, fat fingers. Well, not really fat, I'm just clumsy. CLYMC and then NQH0. Now you can use things like the Qs. You can use, this is odd. It's not opening my,
You could try just opening them one at a time.
One at a time? Okay, all right. So I'll do this. Thank you.
Yeah, and that's actually one of the, while you open that, that was one of the questions I had because you have, you know, a lot of these companies are well, today Microsoft is down 3.5%. Amazon,
Right.
last I checked, 2.7% down. Apple, 2.7% down. So you have an extreme bearish turnover almost. So one of my questions to you was about actually gold as to if you feel like people are going to start moving their money out of the markets because of the coronavirus and start moving money into gold, silver, and things like that.
Okay, so if people do that, they are a little bit late to the party, and it's okay. There is going to be some rotation. It would be not a fabulous thing if people rotated into gold right now because there's an interesting thing going on with the dollar. There's a lot of mechanical motion. So here's the thing. The flight to safety has normally been something like gold or silver. And those sorts of mechanical shifts have been running for a while because there is a prevailing undercurrent of fear associated with how large the central bank balance sheet is getting. Mm-hmm. And so we're approaching trillions, and that makes people nervous. And so the yields are going to continue to drift downward. And so people are going to say, hey, I want to have something that gives me a little bit of comfort, and that thing is going to be gold. Or perhaps they say, you know what, maybe I'll go to cash. So what gold has been doing is it's run about $200 in the last little bit. And let me see if I can find it here. It must be sitting underneath all of my other things. So let's just pull them out one at a time. We'll look at gold. This is bizarre. I don't know. You know what? Here's what Fred is going to do. She is going to, see, I see it, but I don't see it. So let's close. I'm just going to say yes to all. And then we will open this up again. And let's just pop it up one more time. It just might need restarting.
Yeah, sometimes if you're running it on a couple of different monitors, one of them will get stuck on another one.
Absolutely, and that is what has happened to me. So here it is trying to open up. There we go. I love the interface that gives me all the news here from the Reuters platform. It's really great. If you don't have the daily recap for the day ahead, I highly recommend it. I know that the Metastock is an international company, and so there are a lot of folks up there, but the US edition and, of course, the Europe edition are just phenomenal.
Yeah, there's a movers page that I was actually in preparation for this. I was taking a look at.
We can talk about some of those live.
Yeah. Some of the movers and looking at the overall indices worldwide. There's a lot of red.
Yeah. Yeah, there's a little bit of trouble. And, you know, the thing is, we have to realize this, that in this particular market, everybody that's participating has got 1 foot out the door.
Mm-hmm.
That's why things are going to drop that fast.
Mm-hmm.
Nobody's super excited about staying in. That's so weird. All right, let's do the task manager. No one's interested in staying in for the long haul here because everybody knows there's a shoe that's going to drop.
Mm-hmm.
We just know. And so what we have to do is say, if this is the case, how can I fix or position myself appropriately? And so let's end that. Oh no, this is the one I want to end. All right, let's try it again. So the thing, here's where value is sitting. The ratio of silver to gold across time has been somewhere between 49 to 1. So if you take a look at the price of where gold is right now, and then you take a look at the price of where silver is right now, silver is incredibly underperforming as a tool if it's going to have the same ratio. Mm-hmm. So if you're looking for something, I have bought an in-the-money spread. And this is just me, of course, because I like to use options in that space. So I'll buy a strike that's in the money, and then I'll sell the strike that's out of the money. Yes, it binds my upward amount that I can make, but it also limits the amount I can lose, which is what I am most concerned about as a trader, right? Because I live and die by the markets. So let's have a peek at gold, and I'll show you what's been happening. Well, yeah, absolutely. So do you see this huge spike?
Yes.
Right? So for gold, we really have been looking at this area since the year began for buying pressure. So literally, I've said to everyone, for any deep pullback you see in gold, it's a buy, and it's very likely to get to 2,000. Now, this is just my estimation, just what I'm thinking, but there are so many people that are now finally saying, ooh, I probably should be buying some gold, because, you know, if you go to your financial advisor, they'll say, hey, gold has traditionally underperformed the market for the last 20 years. And so people are they have very low amounts. And so now all of a sudden they're seeing it run, and it's really, really starting to move. So the things that you can trade are things like GDX. Let's take a look at GDX. Would it be just plain GDX since it's an ETF?
It should be.
Yes, here we go. Mm-hmm. See the big gap? Mm-hmm. Up at the 30 area, we can see, let me apply my default template here. And then, of course, you know, yes. If there's anything that you want to look at, I am very happy to open it up and take a peek. The one thing I want people to realize is that these are the kinds of markets that really make people nervous. And when they're nervous, they do things that don't make sense from a big picture perspective. And so they'll jump in at a high, or all of a sudden they'll say, hey, I want to, you know, do one thing or another. So right now, this is very big. It's moved up rapidly. It's got gaps in it. And so what I suspect to happen here is something that looks like this. So this is what happens all the time. So if your thought is, wait, I want to get involved, I really need to get involved, the one thing we don't like doing is waiting. We look at something, we go, oh, that's going to move up, I got to buy it now. But if you're managing your money and you're managing it well, the one thing you have to estimate is, wait, what risks can I have if I enter at this time in this space where people feel like things are a little squirrely or nerve-wracking. Okay, and so what I would say is, hey, keep your eye on this. GDX is very reasonably priced. It's got a nice grind to the north. Its options are a little bit, I don't know that the pricing of their options are great, but you can do things like buy, you can look at this and you can go, okay, if I want to get involved in a risk-averse sort of way, but I want to participate, I can look at the support edge and I can say, all right, I want to buy the gold 28 calls and I want to sell the gold 34 calls, or I want to sell the gold 33 calls. Something like that, that gives you an entry point that you know is very likely to hold, because that's really good old resistance, new support. And you look at it out April, May, because this is really when we're going to start having, we're going to have a very volatile summer, in my mind. And so the way to manage yourself during a volatile summer is take a look at something like this and realize it's got a broad motion edge. And essentially, if I bought it in last August and I held on to it, I would literally be at break even. And so there are people that bought in August, and there are people that are thoughtful about, you know what, as soon as this gets back to break even, I'm getting out of here. So these are trapped buyers. And what you want to do is wait for old resistance to retest itself as a support zone. To me, that says it comes in $1. I have to say, full disclosure, many times I wait for it to come all the way back to support, and it just comes mostly into support, and then it leaves me. But I would rather come in a space where I say, listen, if I get in at 29.50 and it falls to 27, that's going to be 5.5% or something like that. I can handle that if I know it's going to bounce. I don't want to put any more at risk. And so that is sort of the big thing. The next thing that's very interesting to look at is on the cover of The Economist today, the cover said the giant move in tech. And so unfortunately, a lot of times we can look at these magazines, and when they come out with these broad-based stories, what's actually happening is that it's the end of a move. Okay? And so very interestingly, that article came out and we had a sell zone today. Now, my thought is always, if you're at a buy zone and you see the red diamond, that's a place you take profit, and then you start making sure that your chart does not break support. The second it breaks support, you get out of Dodge, and you can see it breaking support yesterday. This is a sell zone, but look at how bullish it is. What people are going to say is, you know what, I didn't want to buy at the high. I'm getting price action that's going to be fairly nice. What if I come in, fill the gap? There's a gap right here. And I try to work here. So how, again, do you participate in this kind of way? Two things. You can use the option chains and you can say, all right, I'm going to buy a call that's deep in the money because this is a very bullish chart. I want to go deep in the money. And so that's going to be, say, 94, 95. And you're going to sell something outside of the money like 102, 103. And you're going to go up into April, May. And what it's going to do is give the chart the wiggle room to come down into support and begin to bounce. And it's very, very likely that you do extremely well buying that call and then selling it once the chart gets back up into its old resistance zones, because you have no idea whether it's going to break down or not. This type of spread is called an in-out call spread. It's got a very high level of probability working out as long as you're in an upward trending formation and you go in and you make the purchase at a key support zone that you can see in the distance.
Right.
Anybody want to look at particular charts?
Let's see. We have a couple of questions from our YouTube Live. Greg, take it away.
Absolutely.
There's not stock suggestions. One gentleman, Brett Ondre, says, do you have any thoughts on the inverse of market versus oil? It seems very out of whack.
Okay, so there is a relationship between oil and the markets. The markets are very disjointed right now, and they are disjointed because of the levers that the central bank and the FOMC, the Federal Open Market Committee, the guys who run our interest rates, they've been mucking around in there, just trying to do things that make for absolutely difficult relationships, and they make for the relationships actually breaking. So one of the things that we've noticed that's breaking is the relationship between the market and oil, and the market and gold. In the past, if gold goes up, the market goes down. That's been a relationship, but the market and gold have both been going up. The relationship is also such that if the dollar is up, then commodities are down. But take a look at, wow, I hope this is the right one. Let's see, is it this one? Nope. Okay, so what would the dollar index be? USD, maybe. USD? No, that is, no, let's look for dollar index. Because here's something very, very interesting. The coronavirus, yes, here we go. The coronavirus has significantly affected the dollar, and it's affected the dollar in a very bullish way. The dollar is breaking out into levels that are so high. Take a look at this. This is incredible motion, okay? Normally, if the dollar goes up, commodities go down. If the dollar goes up, gold goes down. Right now, the dollar's been up and gold has been up. The dollar is up because it's a flight to safety. As a currency, we are the furthest away from the coronavirus. And so we have a risk on event would be staying in those other currencies like the euro and whatever else is on the other side. Even the yen and the Swiss franc, all of those having significant amounts of troubles right now, but we are absolutely exploding to the upside. So to answer this question in a roundabout way, because it's a question that comes from knowledge of a prior relationship, those relationships are broken. And because they are broken, trading in those relationships and with those relationships are going to make for some fairly bad trades. So I'm going to say this. The UUP, which moves at the speed of dirt, is the ETF dollar index. And you can look at that one and say, all right, what is likely to happen? Well, what happened the last time the dollar got up here? The dollar has not closed up here in a year. So let's look at the weekly chart and see what that looks like. Woo! So if we take a look at this, the last time we were way up here was 2017. We did have a little bit of a currency crisis here. This is where the Fed, no, that was not that Fed event. The Fed event was here. So here are the big upshots. Right now, this is old resistance. So we are going to have sellers here, folks. We're going to have sellers here. But how it affects oil, other commodities, and gold is a complete unknown. So let's look at the relationships that are working. One of those relationships, really, I like to look at is silver. Gold is getting too expensive for some people who have retirement accounts. And so they're going to be looking at something that is cheaper. And what is going to be cheaper is silver. And the relationship between silver is, like I said, 48-1 usually. Some folks say that it shouldn't be thought of like that. It should be 80-1. Irrespective, this chart is way behind the curve because right now, silver, if we look at the silver contract, it's actually up over 18. So SLV is even moving slower than that. But that's because SLV also has miners sitting inside of it. You're going to start seeing a lot of consolidation of miners, I believe, as miners who want to be bigger and capitalize on the future space are going to gobble up little ones. So start looking at a few of those. Eldorado Gold. They're just a few of them. But again, where are we? If we take a look here, we're right on the edge of a resistance zone. On top of that, these breakouts, listen, I don't know if you've been trading breakouts, but if you are, you're going to be noticing one thing, that you expose yourself to a tremendous amount of risk. Whether it comes back or not, by the time it comes back, you are so uptight about being read so long. When it comes back, you're like, I'm getting out of here. So I want to say this, every breakout needs to be retested right now. We are entering a higher patch of volatility. It's just going to be higher. It's going to be higher because of algorithmic motion on the market. It's going to be higher because of uncertainty towards true global slowdown numbers, true coronavirus impact, anything going on in the Middle East, and on top of that, our own election space here. So I would say, listen, this one's underperforming. It should, if it runs the way gold ought to run, it could easily see 40. But that's going to take a little time, and it's probably going to be a little bit wiggly, right? But more people are going to graft themselves into this silver chart because gold is simply just too expensive for them to hold. If you want to hold gold, I say use the option chains. That's the way you're going to expose yourself. If you have a long call spread, yes, you limit your upside, but you also limit your downside. And that's really the more important thing to manage, limiting your downside.
Yeah, and I think that another thing to take away, pardon me, is the fact that since we are going into such a high level of volatility, we have a lot of volatility right now, plus we have the summer coming up, we have the coronavirus impacting the S&P Tech Index is down 1.9%, which is going to have a huge trickle-down effect.
Yes.
There's a lot of volatility, so understanding, I think that your mentality going into a trade, is this going to be something that I'm going to hold on for a long time because I don't want to deal with the volatility, or am I okay taking the risk on these more volatile stocks? I think going into your trade with the expectation is very important.
Absolutely.
And having those
Absolutely.
trade guidelines in place. We do have another question from YouTube.
Sure.
Okay, where to go? Michael Boland says, the two sector pairs together for us, so we can identify a hedge for this quarter to deal with the anticipated supply chain interruptions, I'm not sure I understand that.
Could you repeat that again, please?
I'll try. He says, I said it wrong. He said, tie two sector pairs together for us, please, so we can identify a hedge for this quarter to deal with the anticipated supply chain interruptions.
That is a very good question.
Okay.
No, please continue.
No, that was it.
Well,
I just wanted to make sure you'd interpreted my...
Yeah, I did interpret it correctly. Here's why I'm having trouble answering that question. I am not a hedger. And so the reason I'm not a hedger is because the way I hedge is, okay, you know, financial advisors will sit down with you and they'll say, time in the market beats timing the market. And the reason for that, it becomes quite complicated to run large swaths of portfolios according to market timing. Now, I just have 3 or 4 portfolios of my own, and so it's not particularly difficult for me to do that. And so I move between spaces of low cash and high cash. And so, for instance, my thought would be the following. Long gold on any pullback, and, you know, golly, there's so much that's disjointed and so much unknown. For me to pick up a pair, and also, here's my philosophy on hedging is twice the risk, half the money. And so twice the risk, half the reward. And that is if things absolutely go wrong in both directions, right? If you hedge, if you say, hey, listen, things are supposed to be long the dollar, short gold, and we decide we're going to go short the dollar and long gold, and they both end up moving in the exact same direction, we're going to have ourselves some trouble. And so I'm a bit of a simpleton as real trading goes, again, because I trade to eat. I have investments that I have to look at constantly that say, okay, at the end of the day, I need to have this kind of return, and I cannot expose myself to this measure of risk. And so what I will do is move to cash or change where I am going to position. And so if I'm looking at long onlys, I would say, hey, listen, wait until tech has a pretty solid pullback, because that thing's been exploding. If you want to play a reversion to the mean, you can say, all right, I'm going to see if I can short tech on a weekly high here and see if it can come into support. But see, at the end of the day, a portfolio manager is paid to add yield. And the toughest thing he's had or she's had trouble with in the last couple of years is actually making the SPX benchmark. And so, you know, my long answer there is I can't deliver one to you in that way, because my mind, the only way I hedge is by saying, hey, I don't like the performance of that sector, or I don't like how far that's ridden up. I'm going to pull 3/4 of my position, 4/5 of my position off, and I'm going to watch it rotate into key support where I will engage again.
Or you could play it very safe and just short Norwegian cruise lines for a little while.
Oh my God, really, right?
Rough.
I mean, the whole cruise ship industry, it was a Petri dish. It's a Petri dish anyway,
Right.
right?
Just makes it all worse now, though.
Exactly.
All right.
Exactly.
We're going to take one more question from YouTube, and then I'm going to throw a couple stocks at you.
Perfect.
Greg, take it away with
Yeah, so it's not a question. Someone did have a security they wanted her to look at. DXY, Delta X-ray Yankee. I'm assuming that's a security, unless this person's using
DXY is a dollar index?
Yeah, I think that's the dollar index. I think we just looked at that.
Yeah, we just looked at the dollar index.
Oh, okay. Apologize. And then that's it so far as your YouTube questions are concerned.
Okay. Wonderful. So we covered the dollar index. I picked a stock with my magical indicators that never fail me whatsoever. I picked a long stock and a short stock, and I want you to tell me if I picked right.
This would be a good time to
Exciting.
remind the audience that they shouldn't take any suggestions you make whatsoever.
Please do not take any suggestions I make.
Whatsoever.
Whatsoever.
Ever.
Any of them, right? This is for educational purposes only.
Any of them. Drink water, though, and stay in school.
Yes.
So
Don't do drugs.
don't do drugs. So, for my short stock today, I picked Hormel, HRL.
HRL. Is that .o?
No, it should be just HRL.
Ooh, nice. Okay. Hormel short. These are the spam guys? They make spam?
I don't know if Hormel owns
You are going to
spam.
short delicious processed meats? Are you insane?
It's their chili.
Listen, can I tell you, in other countries, that is sort of like,
It's like bacon.
Russian caviar.
Yeah.
I mean, they love the stuff. Okay, so that very nice breakdown, right? To me, this looks like, oh my goodness, I've made a ton of money here. I better start taking some profit. That's what this looks like to me. So let's change this moving average. Let's make this something like a 30 exponential. And let's talk about what's actually happened here. So my thought is always, hey, let's just go caveman on it and look at where resistance became support. So here's what'll happen. These guys run up here. This is how our psyche works. We'll buy and we'll see the dips and we'll say, I'm going to have to start watching these tops here. And if I start losing my support, I'm going to take my gains. I'm not, maybe I'm not holding Hormel for the long run or whatever, but my chart is fading. And notice today it closed pretty close to the low. Now here's something very interesting. It is extremely rare that a Friday ever makes a low in a stock. Very, very rare. And so what we could see is a little bit more sell-off. And then people are going to start saying, well, beginning of the year, I'm flat for the year. This chart's really been trying to hang on since last October. I'm going to try and buy right around this zone. So that's the mental capacity. That's what people are thinking. Somebody like me who's a value person is going to say, hey, this is a really bullish formation. In general, it's bullish. So what I am going to have to look for is, where will the bulls begin to resume buying pressure in this particular environment? Oops, integer between, thought I did that. An integer, yeah, so I use a 50. I've got my 50 exponential, so it is way down below those. So here's something very interesting about the nature of motion. I like to use physics in market because I am a math nerd, but physics works this way. If I am moving, let's say you put your hand in a bucket of water and you start turning that bucket of water clockwise, and you move very, very quickly, and then you immediately start turning in the other direction, you're going to have swirls of water that are still going clockwise and swirls of water that are coming with you counterclockwise. We can't always just turn straight around. And so the way that shows up in the market is by buying pressure. So come Monday, we're going to see buying pressure somewhere around this zone. The buyers are going to either come up and they're going to succeed and will close the day on Monday over this low, or they're going to fail and we're going to come down into this area, maybe even a little lower, and then bounce, and then try to handle a support zone here. This heavy congestion means that the volume profile has a lot of buyers saying, I want to buy here. And so those buyers are going to come back and they're going to say, hey, I made money from 44 to 48. And so I'm going to try and buy it again at my 44 to see if I can get to 47, because if not, then my chart is rolling over. So I would say, yes, this is a nice short if you're going to go short range. If you're going to go short for a longer period of time, it's better to look at the weekly chart and realize that, hey, you're at frontline support. If you short it here, it could move $3 against you and resume its trend. Or it could move $3 against you and then rotate downward into, say, the next area of the formation. This is very, look at that. Just a move and then boom.
So we would really
right
need
off.
to see it break below that 44 mark.
Yeah,
to look at it as
or
a little bit of a longer term bearish
yes,
position.
if you're looking at it a longer term, and I know this is very contrary, but give it a whirl. I promise you it's fabulous. If you are looking at something that you want to roll over, it's going to always look like this. Okay, so here we are, big sell zone, right? It sold off right here. This isn't even telling us we have sell pressure, right? This is just saying, hey, you have profit taking. So this formation actually is still bullish. And so it tells us, hey, if you want to go long, you can go long right around this 44. Your stop just needs to be, maybe 43, because it's going to bounce and then fail. So take a look at what happens. Let's say you come in here and you go, ooh, that's a short. And you take it short right here, and it begins to stabilize and it starts to bounce. The moment that it bounces and begins to hold above a moving average, it's a danger zone. Now, so what many of us do is we go, okay, there's my stop. I'm not going to think about it anymore. But you can manage, but not micromanage a position. So now let's take a look at this sell zone. This one says, hey, you can sell this, but it had very bullish motion the first time we were going up. So if we have a sell zone, it's going to bring value buyers in who are thinking this aggressive upside is still going to hold, and they're going to try and bounce it. But the next time it comes into the sell zone, that's where the real sell is going to be. If it's going to happen at all, it's going to happen right there, and it's going to lose the edge of support right in this zone, and you're going to be able to sell it down and really make your profit. Because of that bucket where you have swirling water in both directions, you're going to have traders that go, ooh, I love Hormel. It's really awesome. I'm going to eat my, I guess they do a lot of packaged foods and stuff like that.
Bad
and so I'm
chili.
really into this. I think we're going to have bunker action anyway. And so time to buy the Hormel foods. And so they're going to be coming in and they're going to say, hey, I'm going to try and buy it off this low because that's my value spot. And so when you're thinking about a short, you have to think about, wait, let's pretend value buyers are going to come in here. Where are they going to lose the battle? And back to my little caveman process, it's always going to be, hey, they're going to try and come in at old support. But if they can't recapture that layer of old support, it'll become resistance. And so that is where the sell zone is actually going to come up. I'm going to put an alert on this one. I'm going to put an alert on this one because this would be something that I would say, hey, if I'm looking at it longer term, I would say still bullish, but I might have to wait. I would definitely be waiting to go long on the dip, which is totally contrary. People are always thinking, oh my gosh, I can't buy when it's going down. But you can buy when it's going down if your moving averages have been going up. And so you wait until it comes all the way down, matches that support zone on the edge, and then you go, you know what? If I go long here, that's my least risk and my most reward, because the first thing I'm inclined to do on an upward draft like this is buy.
Okay.
That's what value buyers are going to do. Okay, let's take a look at your long.
My long, and we'll have to do a speed round on this one.
Yes,
Long
I'll do it.
Is Center Point Energy, which is CNP.
Oh, see, I like this one. All right, so let us have a look at a weekly chart here.
Now, one of the things, keep in mind, one of the things that I base my magic system off of is a 200 period moving average, and I do use stochastics a little bit. So one of the reasons I picked this is it spends a lot of time above its 200 moving average.
Wonderful. Okay, so let's make this a 200, and I have the exponential there. And so here it is. Now, this I like as a long, and I like it as a long. Remember, most Fridays do not carry lows, so Monday you're going to see something, and it's probably going to be a dip and then a bounce. Ideally, this is going to be a good, I don't know what business counterpoint, center point is in terms of course, their energy, but don't know what kind. So when they come in here, they're going to run into buyers. So that's superb. If you want to look at things from a risk perspective, you come in first thing Monday, you go, you buy after the first hour, right? Or you watch it come in here. If it comes in here in the first 5 minutes, I'd be all in. The question is, where's it going? And because this 200 exponential is flat, it has a very high likelihood of coming right back into old congestion. So you're easily going to make, what is that, $1, was that 5% on this run to the upside here? And then quite potentially, they look like they've got a little bit of trouble here. I'm not sure what's going on with them, but they seem to be having a little trouble. So I would say this might be a short-term, long perspective. And see, because I have a sell zone here, but that's a Friday sell zone with flat moving averages. And so when you have a buy to trigger with a flat average or a sell to trigger with a flat average, it's always going to bounce at recent congestion or support. And so that is going to be that area. I like this one to move immediately. The other one I like as a short, but you have to wait. And I also like it as a long, but you have to wait. So this is pure action event. This is great. The guys that are really going to have trouble, they're going to bounce and then fail and then bounce and then fail and turn into a big sideways mess are the big tech guys. Microsoft, Amazon, Apple, Google, all of those guys are going to start to trend just a little bit sideways in my mind, which is great news for the iron condor that is well placed. I have a great time doing this, fellas. Thanks so much for having me on. I really do. I know you can tell because of the way I ramble on, but I do love it.
We love your ramblings. It makes for wonderful analysis. There's a lot of information in here. So, again, we appreciate you coming on so much. I know the audience loves it. If you guys have any questions in the audience, we're out of time right now. However, Anne-Marie, can you tell the lovely individuals in the audience how they can get a hold of you if they have any questions?
Absolutely. You can find me on Twitter. I love answering questions there, or StockTwits, or LinkedIn. And you can find me at Anne-Marie Baiynd on LinkedIn, Baiynd. I know we should have anglicized that a lot better instead of leaving all those extra letters in there, but it sounds like rubber band. And you can find me on, I should say marching band because that sounds better, but I just have always said rubber band. Or you can find me on Twitter at Anne-Marie Trades. I'm happy to answer any questions like that, or you can visit us on thetradingbook.com.
Wonderful. And out there, feel free to contact us if you have any questions about the platform Anne-Marie was using, the add-on that she has. It obviously has all the signals that she was using. Anne-Marie, once again, thank you so much for coming on.
My pleasure.
Go out and enjoy the sunshine.
I am. Thanks so much. See you.
See you
Take
later.
care.
And everyone out in the audience, thanks for joining us so much. It's been a true pleasure. Hope to see you next week, same time, same station. Until then, happy trading.